Most people think that turning $100,000 into $1 million requires a stroke of genius, a lucky crypto trade, or a once-in-a-lifetime stock pick. But the truth is far more sober. Chasing the next big thing is the fastest way to turn $100,000 into zero. When you hit the $100,000 mark, something changes. You are no longer just saving money, you are managing capital. This is the threshold where your money starts to have a voice. At an 8% return, this $100,000 earns $8,000 a year. That is nearly $700 a month in invisible income produced while you sleep. You are standing on a gold mine, but many investors freeze at this stage. They become paralyzed by the fear of a market crash, or they become overconfident and start gambling. Today, I am giving you a system designed to survive both fear and greed. This is the 5-Fund Fidelity Blueprint, a strategy built on the pillars of academic finance, low-cost indexing, and extreme diversification. This isn't just about picking funds, it's about building an unbreakable machine that puts your wealth on autopilot. Before we look at the funds, we must understand why we are using Fidelity. In the world of investing, your greatest enemy isn't the stock market, it's fees. A 1% management fee might sound small, but over 30 years, it can devour 30% or more of your total wealth. Fidelity changed the game by introducing zero expense ratio funds. This means they charge you $0 to manage your money. They do this because they want you in their ecosystem. But for the savvy investor, it's a gift. Every dollar saved in fees is a dollar that stays in your account to compound. By using Fidelity's index suite, we are ensuring that our leakage is zero. We are capturing the pure return of the global economy without paying a middleman to guess which way the wind will blow. The first pillar of our portfolio is the Fidelity Total Market Index Fund. We are allocating 40% of our capital here, exactly $40,000. Think of this fund as the heart of the American economy. It doesn't just buy the top 500 companies, it buys over 3,000 companies. It owns the massive tech giants like Apple and Nvidia, but it also owns the mid-sized industrial companies and the small-cap innovators. Why 40%? Because the United States has historically been the most resilient and innovative economy in the world. By owning the total market, you are betting on the collective ingenuity of millions of workers and thousands of CEOs. You don't have to guess which company will be the next Amazon, because you already own it while it's still small. Historically, this fund will fluctuate, but its long-term trajectory has been relentlessly upward. This is your primary engine for wealth creation. The second pillar is the Fidelity International Index Fund, where we place $20,000. Many investors suffer from home country bias, meaning they only invest in the US. This is a mistake. While the US has dominated recently, there have been long stretches, such as the 1970s and the early 2000s, where international markets significantly outperformed the US. By owning companies in Japan, Europe, and emerging markets, you are protecting yourself against a lost decade in America. International stocks often trade at different valuations and move on different cycles. When the US dollar is weak, your international holdings actually become more valuable. This 20% allocation isn't just about growth, it's about insurance. It ensures that no matter which part of the globe is thriving, your $100,000 is there to capture the gains. For the third pillar, we add $15,000 into the Fidelity Growth Index Fund. If the total market fund is the heart, this is the turbocharger. This fund focuses specifically on companies with high earnings growth. These are the disruptors, companies in cloud computing, artificial intelligence, and biotechnology. They don't usually pay dividends because they are busy reinvesting every dollar back into their business to grow faster. However, growth comes with a price: volatility. In a bull market, this fund will likely be your best performer. In a bear market, it will likely be your worst. By capping this at 15%, we give your portfolio the alpha it needs to beat a standard balanced fund, without making the ride so bumpy that you feel the urge to sell during a dip. Now, we must talk about the boring part: the Fidelity Bond Index Fund. We are putting $15,000 here. Most young or aggressive investors hate bonds. They see a 3% or 4% return and think it's a waste of space. But bonds serve a psychological purpose that is more important than their return. Bonds are your anchor. During a market crash, like in 2008 or 2020, stocks can drop 30% in a month. If you have $100,000 and it suddenly looks like $70,000, your brain will scream at you to do something. Bonds usually hold steady or even rise during these periods because they represent guaranteed debt payments. Seeing that your bond fund is still green when everything else is red is often the only thing that keeps an investor from making the catastrophic mistake of selling at the bottom. Bonds buy you the sanity required to stay invested in stocks. The final $10,000 goes into the Fidelity Dividend Index Fund. This fund selects companies with a proven track record of sharing their profits with shareholders. Dividends are real money. Even if the stock market is flat for a year, these companies are still sending you checks. This 10% allocation provides a constant stream of cash flow that can be used to buy more shares when prices are low. There is a powerful psychological effect when you see dividend received in your transaction history. It reminds you that you are a business owner. It shifts your focus from the price of the stock to the income of the business. This shift is the secret to long-term wealth. When you stop caring about daily fluctuations and start caring about quarterly payments, you have officially won the mental game of investing. Now, let's look at what this machine actually produces. With a weighted average return of approximately 8%, which is a conservative estimate based on historical norms for a balanced portfolio, your $100,000 is a ticking time bomb of wealth. In 10 years, without adding a single dollar, your $100,000 grows to $215,892. In 20 years, it swells to $466,095. In 30 years, it reaches $1,006,265. This is the power of the lump sum. Because you are starting with $100,000, the compounding effect is massive from day one. Most people spend 20 years trying to save their first $100,000, only to realize that the next $100,000 comes much faster. But what if you don't just sit back? If you add just $1,000 a month to this specific Fidelity portfolio, that 30-year total jumps from $1 million to over $2.4 million. The combination of a strong starting point and consistent contributions is the closest thing to a financial miracle that exists in the real world. A portfolio is like a garden. It needs a little bit of weeding. You must turn on the Dividend Reinvestment Plan, DRIP. This ensures that every dividend check you receive is automatically used to buy more fractional shares of your funds. Furthermore, you must rebalance once a year. Imagine after a great year in the tech sector, your growth fund has grown from 15% of your portfolio to 25%. This means your portfolio is now riskier than you intended. By rebalancing, you sell that extra 10%, selling high, and move it into the funds that underperformed, buying low. This simple 15-minute task once a year is the only active management you will ever need. It forces you to follow the golden rule of investing: sell high, buy low. At some point, the market will crash. It is not a matter of if, but when. Your $100,000 might drop to $80,000 or even $70,000. This is the moment where most investors destroy their future. They look at the $30,000 loss and feel it in their stomach. They think, I worked 3 years to save that $30,000 and it's gone in a month. They sell everything to protect what's left. Do not do this. A market crash is not a loss unless you sell. In fact, for a long-term investor, a crash is a gift. It allows your reinvested dividends and your new contributions to buy shares at a discount. The 5-fund strategy is designed specifically for this. The bonds and dividends soften the blow, while the total market and growth funds prepare for the inevitable recovery. The stock market is the only store where customers run out of the building when there is a 30% off sale. Be the person walking in. Finally, we must mention tax efficiency. Because these are index funds, they have very low turnover. This means they aren't constantly selling stocks and triggering capital gains taxes for you. If you hold these in a tax-advantaged account like an IRA or a 401k, your growth is even more explosive. The beauty of this 5-fund system is its simplicity. You don't need to read 10K filings. You don't need to watch CNBC. You don't need to wonder if some CEO is going to get fired. You own the system. Complexity is the enemy of execution. The more complicated your portfolio is, the more likely you are to make a mistake when things get emotional. 5 funds are enough to capture all the world's wealth while remaining simple enough to manage on a smartphone. Wealth is not built by being the smartest person in the room. It is built by being the most disciplined. $100,000 is a life-changing amount of money, but only if you have the courage to let it work. It will be tempting to pull money out for a new car or a vacation. It will be tempting to move it into the latest trend. Resist. Trust the math. Trust the diversification. Trust the low fees of Fidelity. In 20 years, you won't remember the daily fluctuations of the market. You will only remember the day you decided to stop gambling and start investing. Boring is beautiful. Boring is what pays for your dream home. Boring is what buys your time back. If you found this blueprint helpful, do me a favor, hit the like button and subscribe. It tells the algorithm that real financial education matters. If you want the specific ticker symbols for these 5 Fidelity funds, check the description below where I've listed them all out for you. And if you have a question about how to adjust this for your specific age or goal, drop a comment. I read and reply to as many as I can. Now, the video is over. It's time to stop watching and start building. Go take control of your $100,000. Your future self is waiting.